couple hours from now, investors are going to hear from Fed Chair Powell when he gives his update on the economy and on monetary policy from the Jackson Hole Symposium. For more on that, let's bring in Drew Matus, head of the Global Economic and Market Strategy team at MetLife Investment Management. I always think of you as more of a fixed income guy, Drew, but if you're at like an insurance company, the global investment strategist should be really good at fixed income because we know what insurance companies need to do. I mean, if people expect money, it has to be there, does it not? I mean,
it does. So most of my job is fixed income.
Yeah.
Well, economics and asset allocation, that kind of thing.
Because when we talk about Powell, we shouldn't be talking about stocks at all, but we do. We can't help it. But it really is about interest rates. You know, I was thinking of something. You remember a month ago when we had the growth scare, and I don't know what your comments were at that time. What if that revision from the BLS we had earlier this week, what if it had been the day after that jobs report when we were all, our hair was on fire? Like this week, it was almost a non-event for the bond market and for the stock market because we're back to thinking soft landing is where we are.
Yeah, well, I mean, this is part of the problem that Powell has to deal with, which is, first of all, the last payroll report wasn't great, but it wasn't, horribly bad. Certainly didn't deserve the market reaction it got. For people who have been paying attention, the labor market's been weakening for a while. And the very fact that we cared about the revisions to payrolls, right? I mean, that also tells you something. I mean,
did we care? I mean, certain people that used it as a political cudgel cared about it.
Well,
but real economists didn't seem to care.
People were looking for it. I mean, it didn't show up, and then people were calling them about it. I mean, I've got better things to do. I'd rather go get a cup of coffee.
But it actually took some pressure off the Fed that they can cut now. Although they're not cutting 50 because it's an emergency, they're cutting because of the labor market's not as tight as we thought.
Well, and that's what Powell has to communicate. He has to get a grip on this idea that the Fed's going to be able to cut hundreds of basis points simply because we have an unemployment rate that's gone above 4%. And part of the problem is they keep talking about, oh, well, financial conditions have eased, financial conditions have loosened. They get into this circular argument, right? So it's like, oh, we disappointed, so financial conditions ease, and then like, oh, because they ease, we can do this. But really, what they're really just talking about is the stock market did this, and so we have to do that. And what he really needs is to separate the Fed from the stock market and really just kind of say, hey, look, we think we're winning the war on inflation. The unemployment rate is going to continue to move higher in coming months, and that's going to put downward pressure on inflation. So, like, we've got this. Now we're just trying to kind of, like, get the plane on the ground, right? And so he needs to articulate why a few rate cuts are going to do that and get people to kind of dial back this idea that they're going hundreds of basis points over the next 6 months.
Yeah, the range of what when a plane lands, I mean, it's just a bad analogy. I wish we had a different one to use because it just makes me nervous. So are we talking about, at this point, I mean, when you're on a plane and the guy's really good, sometimes you don't even feel the wheels touch down. Other times you're like, whoa, I'm glad we stopped and put the brakes on. What do you think this is really going to be this time? Is it going to be just, wow, I didn't even feel that? Or is it going to be bumpy? And then you know what the worst case is? You go off the end of the runway and who knows?
Yeah, I don't think it's going to be particularly smooth. I think it is going to be somewhat bumpy, and in part it's because of the volatility that we're seeing in markets. It's this fixation that has everyone kind of, we used to call it like student body left, student body right. Everyone just kind of, the lemmings all move to the left, and then everything's off balance, and then the lemmings move to the right, and everything's off balance again.
So that's the plane as it's coming in. It's kind of,
well,
it is.
One of those things where you're landing on the prairie, and so there's a crosswind, and you're landing sideways.
Yeah, exactly. Yeah. That's not good. But at this point, do you see a 50 basis point cut in the future, in our future? Ever?
I don't think so right now because the market's not fully pricing in a 50 basis point cut in September yet. It's still kind of priced somewhere in between 25 and 50. Once you start going 25, there's really very little reason to accelerate it.
Well, unless there is a reason.
Unless there is a reason. But then the acceleration prices in. It's not so much about the first few cuts. It's about what the long set of cuts looks like. So think of it as like a whip. People kind of like crack it. and it travels down and it picks up speed as you go further out the time period.
All right. So you don't expect any great surprises end of the day. But if you had to, is he going to be a hawk, a dove, or an eagle? We heard one of the Fed guys say earlier this week they want to be an eagle. I would rather be an eagle. Well, I'd definitely rather be an eagle or a hawk. I do not want to be a dove.
Well, I'm from outside of Philadelphia, so anytime someone wants to say they want to be an eagle. Good for them.
Yeah.
Welcome to our club. But I would say that he doesn't want to be hawkish because he doesn't want the equity market to go down, and he doesn't want to be a dove because the equity market will go down if he's a dove, right? So he needs to be the eagle, I guess. He needs to kind of split the middle.
Weird, though. He should not be thinking about the equity market at all. He should be thinking about money supply. He should be thinking about,
He should be asking himself, what's the unemployment rate that I want to allow the economy to get to, right?
What do you think it gets to?
I think you're clearly going above 4.5 at this point. So the question is, if you cut a few times this year, can you keep it from going much above 5? And I think that's where they should be focused on, and that's what they should be telling the people that is going to happen. The unemployment rate's going to go up, but inflation's going to go down. We're going to finish this inflation battle, but we're not going to let things spiral out of control.
But at 5, you're well into the Somme roll recession forecast, but you don't think that's a real thing. It's like,
I don't actually mind the Somme rule. I think it's a good idea. What it tells you is that once unemployment starts moving higher, and Goolsbee has talked about this,
it's a point higher.
It continues to move higher.
If it's a point higher, you're supposed to have a recession.
Yes, but the reason that happens is because once it starts moving higher, it tends to continue moving higher. Because everyone then goes, oh, my neighbor just lost their job, I'm going to pull back.
Right, and then
the next person gets fired because you're not going out to the restaurant because your neighbor lost their job, and that's how it begins to spiral. And so he needs to make sure that people have an understanding that the Fed's there, and they're going to put some pressure on the economy to kind of keep it going.
Your recession, what is it, 20% in the next year?
It's probably 30% over the next year.
30 over the next year. That's higher than most.
2 times normal.
You have to be scared because you're, like I said, MetLife. You're like Kelly. You have a nightlight?
I do not have a nightlight.